several trends in the investment field, from electric vehicles to the metaverse. Today, we focus on one key trend, ESG investing, which is a trend that can change the world. What are the opportunities there? Before we start, let's quickly review ESG and sustainable finance. ESG is a sustainability concept that consists of three components. E stands for environment, such as corporations' environmental footprint, including pollution and animal welfare. S stands for social, which reflects how a corporation creates value for its various stakeholders, such as through employee well-being. G stands for corporate governance, such as transparent and inclusive management structure. And traditional financing, or finance as usual. A company is solely concerned about shareholder value when making funding decisions, without considering its negative externalities to other stakeholders. In the long run, it is not good for our world, so concept of sustainable finance emerged. Sustainable Finance 1.0 suggests that companies can maximize their financial profits, while they should also ensure that their actions are aligned with social and environmental interests. Sustainable Finance 2.0 emphasizes that companies should pursue three bottom lines that optimize financial, social, and environmental goods at the same time. The ultimate goal is to attain Sustainable Finance 3.0. Companies should prioritize the common good above their financial goals. Promote ESG investing. United Nations Secretary General Kofi Annan proposed the Principles for Responsible Investment (PRI) in 2005 to better align investors with society's objectives. The PRI guides institutional investors to act in the best long-term interest of their beneficiaries, as ESG factors play important roles in determining investment performance. The PRI has 6 principles. First, we will incorporate ESG issues into investment analysis and decision-making processes. Second, we will be active owners and incorporate ESG issues into our ownership policies and practices. Third, we will seek appropriate disclosure on ESG issues by the entities we invest in. 4. We will promote acceptance and implementation of the principles within the investment industry. 5. We will work together to enhance our effectiveness in implementing the principles. 6. We will each report on our activities and progress towards implementing the principles. Now we know what sustainable finance is. Then, how about we take a look at the current development in the ESG market? We can observe an apparent growing trend of ESG assets throughout the years. ESG assets reached $35 trillion in 2020. The European market used to be the leader in ESG investment. However, after a 40% growth of ESG assets over the past 2 years, the US is now the largest market for ESG investment, with an asset size of about $17 trillion, representing nearly half of all global ESG assets. Globally, ESG investment is still growing. Analysts expect that ESG assets will exceed $50 trillion by 2025, representing more than a third of all assets under management. After knowing more about ESG investment, you may want to consider ESG investment in your portfolio. Then, let me share with you some sustainable investment instruments. Sustainable financial instruments can be roughly divided into 2 categories: equity instruments and debt instruments. A sustainable debt instrument is similar to a common bond in structure and prepayment. The main difference is that sustainable bonds incorporate ESG elements in either the purpose of the use for the bond or the interest payment. There are several types of sustainable bonds. Let me explain 3 of them to you. A green bond is a bond that requires the fund to be used for environmental projects, such as energy reduction. A social bond is a bond that involves the funding of projects with social impacts, like providing affordable housing. Finally, sustainability-linked bonds are quite different from the previous 2. The funds of sustainability-linked bonds can be used for general corporate purposes. However, some bond characteristics, such as coupon payments, are linked to specific ESG-related key performance indicators. Failing to satisfy those indicators would mean that a greater debt burden is imposed on the company, which provides an incentive for companies to keep their promise to uphold ESG-related key performance indicators. Thus, sustainability-linked bonds can help reduce negative externalities created during production activities. As bond investment may require a larger investment, retail investors can consider ESG funds. ESG fund is a type of portfolio invested in a basket of securities that are ESG related. The fund can invest in both equities and bonds. ESG funds have their own criteria to screen securities, and only those that meet the requirements will be included into the portfolio. Stock selection criteria depend on the theme of the fund and the investment philosophy of the fund managers. For example, Fidelity has launched several sustainable investment funds, like the Climate Action Fund and the Water Sustainability Fund. The company has also issued sustainable investing exchange-traded funds, such as the Clean Energy ETF and Women Leadership ETF. Let's take the Women Leadership ETF as an example. The fund aims to deliver long-term growth of capital to investors. The fund invests at least 80% of its assets in equity securities of the companies that advance female leadership and development. One of the largest ESG ETFs is the iShares ESG Aware MSCI USA ETF. It is listed on the Nasdaq. This index tracking fund works by tracking the MSCI USA Extended ESG Focus Index, which includes large and mid-cap stocks in the US market. The index maximizes investment exposure to positive ESG factors, such as tobacco and controversial weapons companies are not eligible. At the same time, the index is able to provide risk and return characteristics similar to the MSCI USA index to the investors. Currently, its top 3 holdings are Apple, Microsoft, and Amazon. As for February 2022, its annualized 5-year return is 15.54%, slightly above 15.31% for the MSCI USA index. This performance suggests that investors do not need to sacrifice their investment return while opting for ESG investing. There are also several ESG ETFs listed in Hong Kong for you to consider. Today, I would like to discuss 2 of them. They are Global X China Clean Energy ETF and Haitong MSCI China A ESG ETF. Global X China Clean Energy ETF is a passive ETF that tracks the performance of the selective China Clean Energy Index (NTR). The index focuses on companies that can benefit from the development and increased adoption of clean energy in China. Their top 3 holdings are Tianjin Zhonghua Semiconductor, Xinyi Solar, and China Yangtze Power. Haitong MSCI China A ESG ETF tracks the performance of the MSCI China A ESG Universal Index. The index invests in large and mid-cap securities listed on Shanghai and Shenzhen stock exchanges that are accessible through Stock Connect. The objective of the index is to gain exposure to companies with a robust ESG profile and a trend of improving that profile. Their top 3 holdings are China Merchants Bank, Guizhou Multi, and Contemporary Amperex Technology. Having learned more about ESG funds, you may wonder how an ESG investing strategy is implemented. There are several investment philosophies in ESG investment. The 2 most common are negative screening and positive screening. Negative screening aims to eliminate exposure to specific sectors, like tobacco or the military, or to restrict investment in companies that violate human rights or environmental laws. In short, this approach focuses on not investing in companies with poor ESG standards. Alternatively, fund managers can adopt positive screening. This approach looks for companies that make significant ESG achievements. For example, an index could overweight companies with high ESG scores and underweight companies with low ESG scores. A positive screening ESG fund might also focus on critical industries within a specific ESG theme, like sustainable energy. So, what are the benefits of ESG investment? For a start, it is less risky than comparable investment strategies, as companies with good ESG performance have less exposure to environmental and legal risks. For example, a company that doesn't consider as negative externalities may be subjected to pollution-related lawsuits, strikes, and scandals. Also, companies with good ESG performance tend to attract more active investors who are willing to make changes to the corporate structure to improve corporate governance. A good reputation also helps attract talent, leading to higher productivity. As a result, we can expect ESG-focused companies to deliver better long-term growth to investors. Moreover, environmental and social issues affect us all. Building a better world benefits everyone, including future generations. To conclude, ESG investment can secure a better risk-return trade-off for investors, but also allow us to create long-term value for the society and the world. To conclude, there are two ways for your investment. You can pick an individual company stock. In this case, you can read a company's ESG report to get more information about ESG performance, such as carbon footprint, human capital development, and broad diversity. Then, combined with your analysis of the company's financial performance, you can then make your investment decision. But my most recommended way for ESG investment is to invest in ESG ETFs. This method saves your effort for screening the ESG factors and financial data of individual companies. And, more importantly, it can deliver investors the benefits of diversification. It can significantly lower the investment risk and improve risk-return trade-off. Thank you for watching. I hope this video has helped you learn more about ESG investment. Let's start our ESG investment path today to make better investments and a better world. Thanks again. See you in the next video. Bye!